Welcome to Capital Allocation Lab.
This is our dedicated space for disciplined, long-term investors who really want to strip away the noise of the market.
Right.
We want to help you understand what actually protects your money.
Right.
So we dig into classic financial frameworks to, help you evaluate businesses, navigate complex capital structures, and price risk with absolute clarity.
Exactly. And if you want to join us in doing that, subscribe and like to support more educational episodes.
Yeah, please do.
So today, we are opening up a topic that sounds incredibly dry on the surface.
Oh, totally dry.
Right. But it is literally responsible for some of the most spectacular fortunes lost and made in market history.
Absolutely.
We are pulling directly from Benjamin Graham and David Dodd's foundational text, Security Analysis.
The Bible of Value Investors.
Yeah, specifically, we're doing a deep dive into this often underrated chapter concerning guarantees.
Right. Guarantees, lease obligations, hidden fixed charges.
And this really dangerous, seductive assumption that a strong parent company will just always ride to the rescue of a weak subsidiary.
Yeah, the word guarantee acts almost like an anesthetic on the investor's brain.
That's a great way to put it.
I mean, when we see it printed in bold letters, our critical thinking just shuts down.
Just stop asking questions.
Exactly. And the entire mission of this analysis is to restart that critical engine. Because Graham and Dodd teach us that a guarantee is not some magic shield.
Right.
It only has value if it actually provides a real, enforceable, and, financially durable second source of payment.
So before we jump into the actual mechanics of this, I really want to frame this for you, the listener. As we go through this deep dive, try to keep 3 questions anchored in your mind.
Okay, what are they?
First, what specific claim do you actually own? Second, what exact legal entity is forced to pay you?
Oh, the word forced is key there.
Completely. And third, when a massive economic storm hits, what could physically stop that cash from reaching your hands?
Those are the right questions.
Also, just a really quick disclaimer up front, this analysis is for educational purposes only.
Right.
It is not individualized investment, legal, tax, or accounting advice.
Good to get that out of the way. So I think the best place to start dismantling this illusion of the guarantee is to look at where the practice historically reached its absolute peak.
Which was the 1920s, right?
Yeah, the 1920s. The financial world was just flooded with guaranteed real estate mortgages.
Let me break down the underlying premise first.
Yeah.
Because, on paper, this doesn't sound like a scam. It doesn't sound like a reckless gamble at all.
No, it makes total logical sense initially.
Right. A guaranteed mortgage basically just sounds like a basic insurance policy. Like, if I buy a mortgage bond yielding 5%, maybe I'm willing to accept 4.5% instead.
Right. You take a slight haircut.
Yeah, and I pay that 0.5% difference to a third party to protect me against the borrower defaulting. We accept lower returns for protection against idiosyncratic risk, well, all the time.
We do. And the foundational logic there is perfectly sound. I mean, insurance relies on the law of large numbers.
Yeah.
If an institution pools together thousands of separate independent risks, they can charge a small premium on each one.
And the premiums from the healthy ones cover the bad ones?
Exactly. The mathematical concept works beautifully, provided 3 really strict conditions are met.
Okay, what are the conditions?
First, the original underwriting of the asset must be deeply conservative.
Makes sense.
Second, the entity providing the guarantee has to be genuinely strong and fiercely independent from the entity selling the asset.
And the third?
The economic environment just has to remain somewhat normal.
Okay, wait, let me stop you right there.
Sure.
You just said the guarantor needs to be independent. Historically, who was actually providing these guarantees? I mean, were they separate insurance companies, or were the mortgage sellers just basically guaranteeing their own products?
Well, actually, both structures existed. So in the earlier days, prior to the great boom of the 1920s, the business was largely dominated by established title and mortgage companies in New York.
Okay.
And yeah, they often guaranteed the very mortgages they were selling themselves.
Which seems like a massive conflict of interest. Guaranteeing your own cooking, so to speak.
It is a conflict of interest, but importantly, they operated under relatively conservative constraints back then.
Like, what kind of constraints?
They limited their loans to no more than 60% of a property's carefully appraised value, for one.
That's a pretty healthy margin of safety.
It is. And they avoided taking on massive concentrated risks in single giant buildings.
Yeah.
Plus, they deliberately spread their loans across different geographic areas.
Okay, so even though there was that inherent conflict, the sheer discipline of the management kind of kept the system afloat.
Exactly. I mean, they actually survived the real estate depressions of 1908 and 1921 using those exact practices.
But that brings up a really fascinating psychological trap for investors, right?
How so?
Well, a firm survives a couple of crises, and suddenly the brand name on the door just becomes synonymous with absolute safety.
Oh, yeah, that is exactly what happened. A reputation forged in a conservative era is so often monetized in a reckless one.
Wow, yeah.
As the 1920s roared to life, massive amounts of new capital flooded into the real estate market. And those cautious old guard operators, they were displaced.
Or outcompeted by new guys.
Right, highly aggressive, new entrants. They scaled the business to just an industrial level, and the underwriting standards deteriorated very rapidly.
So no more 60% loan-to-value limits.
Not at all. They pushed the limits aggressively, and instead of paying down old mortgages, they would just renew them for even larger amounts.
And the public just kept buying them because they thought they were still getting that old, safe 1908 product.
Exactly. They were relying on a familiar brand name, completely blind to the fact that the underlying risk appetite and the balance sheet had become completely toxic.
Which is wild.
The volume of guarantees issued just ballooned.
Yeah.
It reached levels that completely dwarfed the actual capital held by the guaranteeing institutions.
So if an analyst had just bothered to look at the total contingent liabilities compared to the equity of these guarantors.
The math would have been terrifying. The actual protection was paper thin.
Which brings us right back to that insurance analogy we started with.
Right.
An insurance company can easily handle, a random kitchen fire on Elm Street.
Sure.
It can handle a lightning strike on Oak Street. But what happens if the entire city catches fire at the exact same moment?
Yeah, that is the concept of correlation. And it's the fundamental flaw here. The problem with guaranteeing real estate mortgages is that real estate risk is highly correlated during a severe economic contraction.
It all moves together.
Exactly. When the real estate market finally broke in 1931, it wasn't some isolated, localized event.
Right. Values collapsed across the board.
And property owners couldn't pay their mortgages. So the companies that sold the mortgages failed.
And the guarantors.
The guarantors faced this tidal wave of simultaneous claims, and they were instantly wiped out.
And that leads to this staggering statistic from the source material. Roughly $3 billion in guaranteed mortgages and participations issued by New York Title and mortgage companies simply evaporated.
$3 billion.
Back then, the guarantee was literally just ink on a page. But wait, I want to push back on one piece of this.
Go for it.
You mentioned that having an independent guarantor was one of the strict conditions for this whole thing to work.
Yeah, I did.
Well, what about the independent surety companies? Like, these were separate financial entities that took on the guarantee risk for a fee.
Right.
On paper, that structure should have been bulletproof. Why didn't independence save them?
Because independence is a structural advantage, but it cannot reverse terrible underwriting.
Ah.
These independent surety companies, they entered the mortgage guarantee business very late in the cycle.
They wanted a piece of the action.
Exactly. They got swept up in the exact same euphoric market psychology as everyone else. And because they were chasing market share, they guaranteed incredibly weak assets.
So when the macroeconomic environment collapsed,
The losses were so immense that even their independent balance sheets just couldn't absorb the blow. Several of these supposedly rock-solid institutions were forced straight into receivership.
so a guarantee does not repeal correlation.
No, it absolutely does not.
If the asset, the seller, and the independent guarantor are all highly exposed to the exact same macroeconomic shock, your second line of defense is just an illusion.
Well said. Though Graham and Dodd are careful to point out a bit of nuance here.
Okay, what's the nuance?
The Great Depression was, an exceptionally severe event. They don't claim that all guarantees are completely worthless forever.
Right, that would be an overstatement.
Yeah, in fact, they note that even during the Depression, some of these guarantees did retain partial value.
Oh, really? How so?
Well, during complex restructuring processes, some solvent guarantors were actually able to step in and offer, say, reduced interest payments.
Better than nothing.
Exactly. Or the liquidation of the guarantor estates eventually yielded some cash recoveries for investors down the line. The outcome wasn't always a binary zero.
That is a crucial takeaway for anyone reading a modern prospectus.
For sure?
When you see a security backed by a third party, you have to run a mental stress test. You can't just assume a full bailout.
No, you have to ask, what is the actual mathematical capacity of this guarantor if everything goes wrong at once?
Right. And if they do fail, what partial recovery might I be looking at in bankruptcy court?
Exactly. The word guarantee should never be the end of your analysis. It is merely the starting point.
Okay, let's flip the script. We just explored how a formal, printed guarantee can sometimes be completely meaningless in the real world.
Yep.
But Graham and Dodd present a fascinating mirror image to this problem.
They do.
Sometimes the total absence of the word guarantee hides a financial structure that is just as strong, if not stronger. I'm talking about leases and long-term contracts.
Right, the quasi-guarantee.
Yeah.
You see, the market is completely obsessed with labels. But true financial analysis is obsessed with cash flow.
Right, substance over form.
Exactly. Graham and Dodd teach us that a long-term lease, or a fixed purchase agreement, often functions as a quasi-guarantee.
It provides the exact same economic support to a bondholder without ever using the specific legal term.
Yep.
Let's do an ELI 5 on this. Explain it like I'm 5.
Okay, I can do that.
How exactly does a company renting a building serve as a guarantee for the people who lent money to the building owner?
All right, let's map out the entities. Company A owns a physical asset. Maybe it's a chemical plant, maybe a retail storefront.
Got it. Company A is the owner.
Right. Now, Company A issues bonds to investors to finance that asset. So Company A owes those bondholders regular interest and the eventual return of their principal.
Okay, standard debt setup.
Now, Company B enters the picture. Company B signs an ironclad long-term contract agreeing to pay Company A a fixed amount of money every single year for the right to use that asset.
So Company B is the tenant paying rent.
Exactly. If the contract is structured so that Company B's payments are legally mandated, long-lasting, and mathematically large enough to cover Company A's bond obligations,
Right.
then who is truly supporting the bonds?
Economically, it's Company B.
Precisely.
The cash is just passing through Company A's bank account on its way to the bondholders.
The security holder is legally looking at Company A, but economically they're relying entirely on Company B.
I want to look at the historical examples from the book because they prove how incredibly powerful this dynamic actually is.
They really do.
Walk us through the Westvaco chlorine products example.
Okay, Westvaco Chlorine Products issued a 5.5% bond in 1927.
Okay.
And they had an arrangement to sell a portion of their chemical output to a subsidiary of the massive Union Carbide Corporation.
Union Carbide being a giant blue chip entity.
Huge. As part of this complex purchase agreement, the Union Carbide subsidiary legally committed to making fixed monthly payments directly to the trustee who managed the Westvaco bonds.
Direct to the trustee. Wow.
Yeah. The payments were meticulously calculated to cover the ongoing interest and the eventual retirement of those bonds.
So even though the piece of paper said Westvaco, the actual financial muscle pulling the weight was a subsidiary of Union Carbide.
Exactly.
And how did that play out when the Depression hit?
It created a staggering divergence in the capital structure. I mean, during the absolute worst days of the Depression in 1932 and 1933,
Yeah.
the common stock of Westvaco completely collapsed. It plummeted from a high of 116.5 down to just $3 a share.
Oh, wow. So the equity was basically wiped out.
Nearly wiped out.
Yeah.
But those 5.5% bonds,
What happened to them?
they barely flinched. They stayed incredibly stable, trading at 99 cents on the dollar.
Wait, really? That is wild. The same company, the same macroeconomic nightmare. But if you held the equity, you lost your shirt. And if you held the bond, you slept soundly.
Because the bond had that contractual pipeline of cash from Union Carbide protecting it.
The market clearly understood the power of that specific contract.
Well, in that case, yes. But Graham and Dodd point out that the market doesn't always get this right.
Oh, they definitely don't.
Very often, investors completely misprice these quasi-guarantees because they simply don't bother to read the underlying lease agreements.
And the ultimate proof of that is the Tobacco Products Corporation of New Jersey.
Oh, that is a classic case.
This is literally one of my favorite stories in the book because it shows the market being demonstrably, embarrassingly wrong.
Okay, so the setup here is vital to understand. Tobacco Products Corporation owned physical properties that were leased to the giant American Tobacco Company.
A massive 99-year lease.
Exactly. And it required American Tobacco to pay a fixed annual rent of $2.5 million.
Okay.
Furthermore, there was a specific sinking fund arrangement attached to these rental payments.
Okay, let's clarify sinking fund for the listener real quick.
Sure.
That means a portion of that $2.5 million in rent wasn't just going into some slush fund.
Right.
It was legally required to be set aside and used to systematically buy back and retire the tobacco products' 6.5% bonds over time.
Exactly. The rent payments were mathematically engineered to retire the bonds in full long before they actually matured.
While easily covering all the interest along the way.
Yep. And additionally, the contract gave American Tobacco the right to commute the lease.
Commuting a lease. Explain the mechanics of that for us.
Commuting a lease basically means buying your way out of the future ongoing obligations by paying a massive lump sum today.
Like paying off a mortgage early.
Pretty much. You calculate the present value of that $2.5 million a year for the remainder of the 99 years, discounted back at a predetermined rate.
Which in this case was 7%, right?
Wow. Yes, 7%. And if American Tobacco chose to do that, that massive lump sum would immediately flow through and pay off the tobacco products bondholders.
So if you are an analyst looking at this setup, you realize that the tobacco products bonds are effectively the senior fixed obligations of the American Tobacco Company itself.
Yes, because American Tobacco legally has to pay that rent before they can pay dividends to their own stockholders.
Therefore, logically, the tobacco products bonds were a fundamentally safer, more secure claim than American Tobacco's own preferred stock.
Absolutely.
Yeah.
A lease payment is a mandatory legal charge. A preferred stock dividend is discretionary.
Right. A board of directors can just choose to suspend a dividend if times get tough.
Exactly.
Okay, so the logic is completely airtight. The bond is safer than the preferred stock.
Right.
How did the brilliant, efficient market price these two securities in 1932?
The market got it completely backward.
Of course they did.
The supposedly safer tobacco products bonds were aggressively sold off. They dropped to a price of 73.
Which means they were offering a massive yield of 8.9%.
Exactly.
Yeah.
Meanwhile, the riskier junior claim, the American Tobacco preferred stock, was trading at a price of 95.
Offering a much lower yield of just 6.32%. I love pointing out historical inefficiencies like this.
It's amazing.
The market was literally demanding a higher yield, meaning they perceived higher risk for an ironclad, contractually protected senior asset.
Simply because the name on the certificate was tobacco products instead of the famous American Tobacco.
Investors were paying a premium for a prestigious brand name and just completely ignoring the actual legal contract.
And the footnote to that story proves the point perfectly.
What happened?
American Tobacco eventually did exercise their right to commute the lease.
Oh, wow.
They paid the massive lump sum, and the tobacco products bonds were fully redeemed at par value.
100 cents on the dollar.
Yep. The investors who understood the economic substance over the legal label made an absolute fortune.
That is the reward for doing the deep fundamental work.
It is. But Graham and Dodd immediately hit us with a warning right after this.
Right, because you can't just see the word lease and blindly assume it's as good as gold.
Exactly. They offer a counterexample to show how this can fail.
Yeah.
And they use the Georgia Midland Railway.
Okay, tell us about Georgia Midland.
Georgia Midland issued first mortgage bonds paying 3%. The underlying physical railway was leased to the massive Southern Railway system until the year 1995.
Okay.
And the annual rental payment on that lease was designed to be exactly equal to the interest owed on the bonds.
I mean, on the surface, that looks identical to the tobacco products situation.
It really does.
You have a long-term lease from a giant corporate player, perfectly covering your interest payments, but you're telling me the market hated these bonds.
We did. The bonds traded at severely depressed prices.
Why?
The reason is that simply covering the interest payments for a period of time doesn't solve the ultimate problem of the bond's maturity.
The principal repayment.
Exactly. When those bonds eventually came due in 1946, Georgia Midland would need to refinance them.
Right.
And would they be able to roll over the debt at that low 3% rate? That depended entirely on the general credit environment and the willingness of Southern Railway to keep supporting the asset.
But wait, why wouldn't Southern Railway just keep supporting it? If they leased it until 1995, clearly they wanted the asset, right?
Not necessarily. And this is where the analyst has to look beyond the legal contract and examine the physical, on-the-ground economic reality.
What was the reality?
Well, Graham and Dodd note that if you looked at the private traffic density data for the Southern Railway system, it revealed a pretty harsh truth.
Which was?
The specific stretch of track owned by Georgia Midland was completely unstrategic.
Oh.
It had very low traffic. It was not a vital choke point or a core artery for the broader Southern network.
So Southern Railway might just be paying the lease because it was a minor annoyance.
Right.
But if a severe crisis hit, they would have very little economic incentive to fight to keep that specific asset.
Exactly. They might use a bankruptcy proceeding to reject the lease entirely and just walk away.
The legal contract dictates what should happen in normal times,
Right.
but the underlying strategic economics dictate what will actually happen in a crisis.
That's the key. If an asset is vital to the lessee's survival, that quasi-guarantee is incredibly strong.
But if the asset is expendable, the lease is fragile no matter how many years are left on the term.
You got it.
This translates so perfectly to modern markets.
Oh, absolutely does.
I mean, today, an analyst might be looking at a power purchase agreement for a solar facility
Sure.
or a long-term take-or-pay contract for an energy pipeline. The exact same questions apply.
Is the counterparty financially strong?
Right. Does the length of the contract match the maturity of the debt?
And crucially, is that specific solar farm or that specific pipeline genuinely strategic and necessary for the counterparty's business?
Because if it isn't, that contract might be renegotiated the second there is trouble.
Exactly. And that brings us to a fascinating structural market quirk.
Which is?
Because these arrangements require such deep analysis, the market frequently underprices guaranteed or quasi-guaranteed issues compared to the direct, unsecured debt of the guarantor itself.
Right. Graham and Dodd point to the San Antonio and Aransas Pass Railway First Fours.
Yes.
These bonds had a physical mortgage on the railway assets, and they carried the full, explicit guarantee of the Southern Pacific Company for both principal and interest.
So you're getting two layers of protection there. A hard asset claim, plus the corporate guarantee of a major enterprise.
Yet these bonds yielded more than Southern Pacific's own unsecured general obligations.
Which is crazy. The market was paying you a higher yield to hold the safer, double-protected security.
And they highlight similar mispricings with companies like Barnhart Brothers and Spindler, Heilers of Delaware, and Armour.
There's a really important philosophical point here about how we view corporate support.
Okay, what is it?
Graham and Dodd furiously reject the idea that a parent company pays a guaranteed bond out of some sense of strategic wisdom or good corporate citizenship.
Right, it's not charity.
No, if a binding legal guarantee or lease exists, the payment is a matter of strict legal compulsion. It is not goodwill.
The market constantly blurs the line between a legal requirement and a reputational expectation.
And our job as investors is to draw a hard, bright line between the two.
Okay, so if we accept that a lease is economically equivalent to a bond,
Yes.
if we accept that rent acts exactly like interest,
It does.
then the standard way most people calculate a company's safety margin is completely dangerously wrong. We have to talk about rent.
Oh, absolutely. The failure to account for hidden fixed charges is one of the most common ways analysts get blindsided.
Graham and Dodd state unequivocally that all obligations equivalent to bond interest must be included in your coverage calculations.
In heavy industrial businesses, where companies generally own their factories and issue bonds, the math is straightforward.
Right, you just look at the funded debt on the balance sheet.
But in sectors like retail, where massive physical footprints are often leased,
The traditional balance sheet tells a massive lie.
a huge lie.
Let's run a thought experiment to make this perfectly intuitive for you listening.
I like thought experiments.
Imagine two massive retail chains. They sell the exact same products, generate the same revenue, and have the exact same operating profit margins before we factor in the cost of their buildings.
Okay, identical operations.
Right. Now, Chain A decides to purchase all of its store locations. To do that, it issues a mountain of bonds and pays regular interest to its bondholders.
Okay.
Chain B decides to lease all of its store locations from real estate developers. It has zero bonds, but it pays regular rent to its landlords.
Got it.
If an unsophisticated analyst runs a screener looking for safe, low-debt companies,
Chain B looks like a pristine, conservative fortress. I mean, their balance sheet shows literally no funded debt.
well, Chain A looks heavily leveraged.
But economically, that distinction is a complete illusion.
Exactly.
Both the bondholder in Chain A and the landlord in Chain B demand a massive, fixed, mandatory check every single month.
And if that check bounces, the business goes bankrupt.
The equity holders in both chains are sitting behind a massive wall of fixed obligations. The obligation is practically identical. The accounting presentation is vastly different.
Graham and Dodd highlight this using real retail comparisons from the era.
Yeah, they look at the preferred stock of interstate department stores compared to the outlet company.
Okay, and how did they compare?
Well, to a casual observer, their earnings coverage ratios and debt levels might have looked pretty comparable. But underneath the surface, the outlet company was remarkably stronger
Why is that?
because it owned its valuable real estate outright. It didn't have that hidden wall of rent obligations. Interstate department stores, on the other hand, was heavily burdened by leases.
And they draw the exact same contrast between J.C. Penney, which heavily leased its stores, and S.H. Kress, which owned more than half of its properties free and clear.
Yes.
And then they drop the hammer with the story of United Cigar Stores.
Oh man, United Cigar.
This is just a terrifying case study of how a pristine balance sheet can mask a terminal disease.
In 1928, United Cigar Stores was considered an elite, highly stable enterprise.
Blue chip stock.
Totally.
Yeah.
They proudly reported to the public that they had zero funded debt, and their earnings were massive. I mean, they covered their preferred stock dividend roughly 7 times over.
7 times coverage with zero debt.
You could sell that stock to a widow or an orphan and sleep perfectly at night.
Until the economic weather changed.
Exactly. United Cigar Stores had built an empire on long-term store leases.
Right.
And when retail revenues plummeted during the Depression, those rent obligations did not adjust downward.
They remained fixed.
Fixed and brutal. The burden of that rent completely crushed the company's operating cash flow.
Wow.
By 1932, this supposedly invincible, debt-free company was driven straight into bankruptcy by its landlords.
Unbelievable.
And the preferred stock, which looked so incredibly safe just a few years earlier, was pushed to the brink of total wipeout.
That story should be required reading.
I agree.
The phrase no funded debt simply means the company didn't borrow money in the bond market.
It tells you absolutely nothing about the actual fixed claims draining the cash flow.
So how do we fix this? Because Graham and Dodd admit that adjusting for rent is pretty messy.
It is messy. You can't just take every dollar of rent and treat it exactly like interest.
Because rent is a hybrid expense, right?
That's the intellectual challenge here. When you pay rent, part of that payment is effectively the cost of capital, the financing cost of the building.
Sure.
But another part is just a basic operating expense. It covers heating, basic maintenance, the physical utility of the location.
So you have to separate the financing component from the operating component.
Exactly. Graham and Dodd offer 2 methodologies to try and untangle this. The first is what they call the severe test.
Let's walk through the math of the severe test.
Okay, the severe test is incredibly punishing. You simply take the company's earnings and you add 100% of their rental payments directly to their fixed interest charges.
Wow, okay.
You treat every single dollar of rent as if it were pure debt service.
Do they give an example?
They use Swift & Company. So, from 1934 to 1938, Swift's earnings covered its pure interest charges by a very healthy 5.1 times.
That's solid.
But if you apply the severe test and add all their rent payments to those interest charges,
What happened?
the combined burden was still covered about 3.8 times by earnings.
So Swift & Company was such a financial fortress that even if you treated every penny of their rent as toxic debt, they still passed with flying colors.
They did. But Graham and Dodd immediately concede that the severe test is probably too harsh for the real world.
Right. I mean, if you apply the severe test universally, you will screen out perfectly sound investments.
You definitely will. So they propose an alternative, which they call the compromise test.
I love the mechanics of this. How does the compromise test work?
The formula takes exactly 1/3 of the annual rentals paid for building space and adds only that 1/3 portion to the company's fixed interest charges and preferred dividends when calculating coverage ratios.
Why exactly 1/3?
It was their best estimation of the pure financing component of a lease.
Oh, I see.
By adding 1/3, you penalize the company for the hidden debt burden, but you don't penalize them for the necessary operating costs of having a physical storefront.
That makes a lot of sense.
They also suggest adjusting the minimum acceptable coverage ratios depending on the industry.
Give me an example of that.
Well, retail businesses tend to have more stable, predictable cash flows than heavy manufacturing, even though they carry massive rent burdens.
Right.
So for a retail bond, they suggest that earnings should cover interest plus 1/3 of rentals by at least 2 times rather than demanding a strict 3 times coverage.
Okay, let's put some names to the numbers. How did this test look in practice?
They apply it to Lowe's 3.5% bonds. Lowe's easily passed. Their interest plus 1/3 of rentals were covered 3.71 times.
Nice.
Then they look at 2 retail preferred stocks. McClellan passed the test. Their combined burden was covered 2.87 times,
Okay.
but McCrory failed.
What were their numbers?
McCrory's earnings only covered the combined burden of interest, preferred dividends, and 1/3 of rentals by 2.3 times.
I want to highlight something incredible about this section of the text. Graham and Dodd are literally the godfathers of value investing.
Yes, they are.
Yet when they introduce this one-third formula, they do it with intense intellectual humility.
They do. They openly admit that the one-third rule is somewhat arbitrary.
And they acknowledge that finding accurate rental data in the 1930s was incredibly difficult.
They even warn that strictly applying this mathematical formula might give you results that seem completely out of step with what the rest of Wall Street thinks.
That humility is the mark of a true master. I mean, they aren't handing down a magical, infallible equation.
No, they're trying to instill a mindset.
Exactly. The exact fraction, whether it's 1/3 or 1/4 or 1/2, matters far less than the fundamental spirit of the exercise.
And the spirit is this: you must never let accounting conventions blind you to economic reality. Mandatory claims on cash flow are dangerous, regardless of what legal label the accountants paste over them.
Right. If you are an equity investor, you have to realize that every landlord stands in line ahead of you.
Their rent checks must clear before you see a dime of profit.
And if you own bonds, those landlords are aggressively competing against you for the exact same pool of operating cash flow.
Ignoring the difference between a company that owns its assets and a company that leases its assets makes any comparative analysis functionally useless.
Okay, before we dive into the final massive trap of subsidiary bonds, there is a technical but necessary point we need to cover.
Sure, what is it?
Let's say we've done the work, we've adjusted for leases, we are looking at a genuinely guaranteed bond,
Right.
but the issuer of the bond and the company guaranteeing the bond are two completely separate corporate entities. Which income statement am I supposed to be analyzing?
Well, there is no rigid template. You have to let the specific economic realities dictate the framing.
Okay.
Graham and Dodd outline 3 distinct analytical lenses for this situation.
What's the first one?
The first lens evaluates the issuing company's own standalone operating results.
Makes sense.
The second lens looks at the combined, consolidated results of both the issuer and the guarantor together.
And the third.
The third lens looks at the guarantor's overall ability to cover its own organic charges, plus all of the various guarantees it has absorbed across its entire system.
So I can't just blindly download the parent company's consolidated 10K and assume it tells the whole story.
Never. They point to the Neisner Realty case, where looking at the combined, consolidated setup made logical sense.
Okay.
But then they highlight the Indiana Harbor Belt situation. In that case, the subsidiary actually had much stronger standalone earnings coverage than the overall guarantor system.
Interesting.
And for the Soo line, the only way to understand the true risk was to evaluate the guarantor against the massive global pile of obligations it had assumed.
You have to trace the legal reality of the contract, not what happens to be easiest to plug into a spreadsheet.
Precisely.
Which perfectly sets up the single biggest warning of this entire analysis.
Oh, the subsidiary trap.
Yes. We have spent an hour talking about how investors frequently ignore or underprice legally binding support structures like formal guarantees and leases.
Right.
But when it comes to subsidiary bonds, investors do the exact opposite.
They vividly hallucinate rock-solid support where absolutely no contract exists.
It's wild.
The illusion of corporate association is arguably the most dangerous trap in modern finance.
Let me play devil's advocate here for a second.
Okay, go ahead.
I am an investor. I open up the annual report for a massive holding company. I am looking at a pristine, consolidated income statement.
Beautiful numbers.
The parent company is generating billions in revenue. They have massive margins, oceans of cash, huge equity value.
Right.
Deep inside that empire is a tiny subsidiary that issued some bonds. Why on earth should I lose sleep over the debt of that tiny subsidiary when the parent company is so obviously rich?
You should lose sleep because the wealth of the parent company does not belong to the creditors of the subsidiary.
Boom, there it is.
Unless that wealthy parent has explicitly, legally assumed responsibility for that debt through a formal guarantee.
Your comfort is entirely fabricated.
Entirely. Graham and Dodd point out that standard accounting practices actually actively encourage investors to make this catastrophic mistake.
Wait, how does the accounting encourage it?
Think about how a consolidated income statement is built. The accountants take the revenues of all the subsidiaries and lump them together.
Right.
Then they take the interest owed by all the various subsidiaries, lump it all together, and present it as a single senior charge deducted from the total combined earnings.
Oh, I see.
This optical illusion makes it look as though the massive, unified cash flow of the entire empire is standing shoulder to shoulder behind every single bond.
It makes the subsidiary debt feel like parent company debt.
But legally, it isn't. If a specific subsidiary starts losing money and becomes a drain on the empire,
The parent company doesn't have to save it.
the rational move for the parent is often to simply amputate the dying limb.
Wow.
They will write off their equity investment in the subsidiary and let it go bankrupt, rather than drain the parent's cash to pay off the subsidiary's bondholders.
Because the parent company's legal obligation is to its own shareholders, not to the unsecured creditors of an unguaranteed subsidiary.
Exactly. And the primary historical example Graham and Dodd used to prove this is an absolute masterclass in pain.
Let's hear it.
Let's look at the United Drug Company 5% bonds.
Walk us through the setup.
United Drug was a major operating subsidiary owned by a massive, highly profitable parent holding company called Drug Incorporated.
Okay, Drug Inc.
If you looked at the consolidated financial results for the Drug Inc. empire in the first half of 1932,
How did they look?
the numbers were spectacular. The consolidated earnings were roughly 10 times larger than the interest required to service United Drug's bonds.
10 times interest coverage. I mean, an investor sees that and thinks the bonds are practically risk-free.
And the market treated them as risk-free. The consolidated exhibit was viewed as conclusive proof of safety.
Bet.
But the investors failed to check the actual legal architecture. The United Drug bonds were not guaranteed by the parent company, Drug Inc.
That is the missing link, but how did the collapse actually trigger?
It triggered through another layer of hidden risk.
Oh, no.
Yeah. United Drug, the subsidiary, issuing the bonds owned stock in yet another entity called the Louis K. Liggett Company.
Okay.
The Liggett Company operated a vast chain of retail drugstores, and they had taken on an enormous burden of long-term store leases.
Rent again.
Rent again. In September of 1932, the crushing weight of those leases finally broke them. The Liggett Company told their landlords that if rents weren't drastically slashed, bankruptcy was imminent.
So, suddenly, this hidden iceberg of lease liabilities rips open the hull of the Liggett Company. How does the market react when they realize this is going to impact the United Drug bonds?
The market suffered a violent awakening. Investors suddenly realized the hard, legal firewalls separating these companies.
Right.
If the wealthy parent, Drug Inc., had absolutely no legal obligation to pay the lease liabilities of the Liggett stores,
Then Drug Inc. also had absolutely no legal obligation to step in and pay the interest for the United Drug bondholders.
the illusion of the consolidated statement shattered.
And the mathematical devastation that followed is just brutal.
Tell them the numbers.
The United Drug bonds crashed from a price of 93 down to 42.
Ouch.
There were $40 million of these bonds outstanding. Practically overnight, the market revalued them at just $17 million.
Massive destruction of wealth.
More than half the value gone. But wait, what happened to the wealthy parent company during this exact same period?
The parent company's equity remained perfectly safe, valued by the market at well over $100 million.
Let that sink in. The parent company has $100 million in equity value sitting right there.
Right.
But the subsidiary's bondholders suffer massive catastrophic losses because they have no legal right to touch that parent-level wealth.
Following this disaster, the holding company system was eventually dissolved.
Interesting.
United Drug was forced to resume its existence as a completely separate, standalone entity.
And how did that go?
Once it was stripped of its wealthy parent's halo, its standalone earnings were exposed as entirely inadequate to support its bonds.
Wow. To prove this wasn't just some bizarre one-off fluke, Graham and Dodd provide two more examples.
They point to the Consolidated Traction Company of New Jersey.
Okay.
This was a very large but deeply unprofitable subsidiary owned by the massive Public Service Corporation of New Jersey.
Let me guess. No guarantee.
The parent company had never guaranteed the subsidiary's debt. When the Consolidated Traction bonds matured in 1933, the parent refused to engineer a bailout.
Oh.
Many bondholders were forced to accept a grueling settlement of just 65 cents on the dollar.
And what about Saltex Looms?
Saltex Looms was the subsidiary of Sidney Blumenthal. They eventually defaulted entirely on their first 6% bonds.
What makes the Saltex case so insidious?
It's the accounting. For years prior to the default, the parent company's consolidated statements had dutifully deducted the Saltex bond interest as a senior charge before calculating the parent's preferred stock profit.
Ah, so the accounting made the debt look integrated and perfectly safe.
Exactly. But when the default hit in 1940, the Saltex bonds plummeted to a horrific price of just 7 cents on the dollar.
7 cents.
Meanwhile, the parent company's preferred stock continued to trade comfortably above 70.
So relying on a consolidated statement isn't just lazy.
No, it is actively perilous if you own subsidiary debt.
Graham and Dodd draw a brilliant, unyielding rule here.
What's the rule?
If you are buying the equity of a holding company, you absolutely must use the consolidated picture because all the debt of all the subsidiaries legally ranks ahead of your equity claim.
Right.
But if you are buying an unguaranteed bond issued by a subsidiary, you must completely throw out the consolidated report. It is invalid for your purposes. You must demand the subsidiary's own standalone financial exhibit.
And if management makes that standalone exhibit hard to find or, buries it in complex disclosures.
You have to dig until you find it. Because, as Graham and Dodd state, from the standpoint of fixed value investment, nothing important may be taken for granted.
That is so true. We have spent this entire discussion watching investors make two opposite but deeply related errors.
Right.
They systematically underestimate the power of a legally binding contract, like a true guarantee or a lease.
And they systematically overestimate the power of a mere corporate relationship, like a parent and a subsidiary.
Both errors happen because investors prefer the comfort of a narrative over the rigor of legal structure.
Which brings us to the ultimate investor checklist.
Let's do it.
We are going to synthesize everything we've discussed into 8 rapid-fire points that you can apply to any complex capital structure today.
Point number 1. Identify the exact promise. Do not just look for the word guaranteed. Read the actual text. Are you guaranteed principal? Are you guaranteed interest? Is it just a commitment to pay rent or a promise to fund a sinking account? Know precisely what the contract demands.
Point number 2. Identify the actual obligor. Strip away the marketing, the holding company umbrella, and the famous logos. Which specific, exact legal entity is legally required to sign the check?
Point number 3. Distinguish contractual rights from expected goodwill. A formal guarantee or a long-term lease is a legally enforceable right. A sponsor's historical reputation for supporting its affiliates is a hope. Never price a hope as if it were a contract.
Point number 4. Study independence and correlation. If a guarantor operates in the exact same industry, relies on the exact same collateral, and faces the exact same economic shocks as the original issuer, your guarantee provides zero diversification. It will fail exactly when you need it to work.
Point number 5. Hunt for hidden fixed charges. Do not rely on the line item for funded debt. Look for massive lease obligations, take-or-pay contracts, and any mandatory cash outflows that sit senior to your position. Rent is debt wearing a disguise.
Point number 6. Demand the right financial statements. If you own a guaranteed bond, combining the financials might be appropriate. But if you own an unguaranteed subsidiary bond, only the standalone subsidiary numbers matter.
Point number 7. Stress test for the truly bad year. Guarantees look bulletproof in a bull market. You must ask if the guarantor actually has the excess balance sheet capacity to absorb a massive wave of simultaneous claims during a correlated macroeconomic crash.
And point number 8. Hunt for market mispricing. The market hates complexity and loves famous names. Look for opportunities where an ironclad, quasi-guaranteed contract is trading at a discount simply because it lacks a prestigious label, and avoid junior claims that are trading at a premium just because of the parent company's halo.
If you internalize those 8 points, you will immediately separate yourself from the vast majority of market participants who are still just reacting to the bold print on the cover page.
Before we wrap up, I want to leave you, the listener, with a totally new, provocative thought that builds directly on everything we've covered.
I like provocative thoughts.
We have spent an hour dissecting how corporations hide liabilities, use quasi-guarantees, and rely on the illusion of parental support.
Right.
But what happens when governments play the exact same game?
Oh, that's a big question.
Think about implicit sovereign guarantees. Think about massive state-owned enterprises holding mountains of shadow debt.
It's the exact same dynamic.
The market constantly assumes that a government will always bail out a quasi-state entity, just like investors assumed Drug, Inc. would bail out United Drug.
Yep.
When you apply Graham and Dodd's logic to sovereign wealth and state-owned entities, the exact same terrifying questions emerge.
Who is actually legally forced to pay?
And do they have the mathematical capacity to do it if a systemic crisis hits?
The scale is infinitely larger, but the fundamental illusion remains exactly the same.
And navigating those illusions is what we do here.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
We want to hear from you. Leave a comment below with your thoughts on this chapter. Let us know what questions you want us to tackle next, and tell us the next fundamental investing concept or complex capital structure you'd like us to discuss.
Until next time, keep reading the footnotes and never take the word guaranteed for granted.